Hello everyone, welcome back to my channel Living in My Own World. This is Lokeshwari. In this video, we are going to learn basic accounting terms which explain with simple and easy examples. And in today's video, we are going to understand the process of accounting explained with simple language and easy examples, especially for beginners and commerce students. So let's get started. First, let us understand what accounting process means. Accounting is a systematic process of recording financial transaction of a business. Every time a business buys something, sells goods, pays expenses or receives money, all these activities are recorded through accounting. So, in simple words, accounting helps us keep proper financial records and understand the financial position of a business. Now, the accounting process is completed through six important steps. They are recording, classifying, summarizing, analyzing, interpreting, and communicating. Now, let us understand each step by one with example. Firstly, it starts with recording. It is the first and most fundamental step in accounting process. It involves documenting every business transactions that occur, whether it's a sale, a purchase, a payment, or any such financial activity. So these transactions are recorded in the document known as journal. The journal is a detailed record that captures all financial activities in chronological order. In larger businesses, depending on their scale and complexity, the journal may be broken down into additional auxiliary books. These could include books for a specific areas like sales, purchases, or payroll, which help organize transactions by category. For example, company might have separate records for sales bills, passbooks, and salary slips to ensure that every transaction is accurately logged. By systematically recording these activities, the business ensures that its financial records are complete and up to date. This step is critical as it forms the foundation for further processes like classification and summarization, ensuring that all financial information is properly captured and easily accessible for future use. Classifying is the second step in accounting process. So, where recorded data is organized into categories to make it easier to understand and analyze. Once transactions are recorded in the journal, they are examined and grouped by their names and nature. This process helps ensure that similar financial transactions are stored together in one place, providing a clearer view of business financial activity. The primary tool of this classification is ledger, a book that contains various accounts. Each account represents a specific category of transactions such as advertising, rent, wages, etc. So, for example, all expenses related to advertising will be grouped under advertising account in the ledger. And same applies to other categories like printing and stationery or salaries. By classifying the data, Business can easily calculate and review the total amount spent in each area. This not only makes financial tracking more efficient, but also helps in assessing spending patterns and making informed decisions about future financial management. So, this step is vital for presenting financial information in a clear and organized way. Moving on to summarizing. The preparation of clear financial statement is essential step in accounting as it allows businesses to summarize their financial activities in a straightforward and understandable manner. These statements typically include the profit and loss account and the balance sheet, which provide key insights into a company's financial health. The profit and loss account details the business revenues and expenses, showing whether the company has made a profit or incurred a loss during a specific period. The balance sheet, on the other hand, outlines the company's assets, liabilities, and equity, offering a snapshot of its financial position at a particular point of time. These statements are organized to serve both internal and external users. Internal users are like managers who rely on the data to make informed decisions, while external users such as investors or regulators use this information to evaluate companies' performance and financial stability. So one of the key tasks is categorizing the assets into fixed and current assets to provide a clearer view of the business's financial standing. This falls under analyzing. Fixed assets such as property or machinery are long-term investments that help generate revenue over time. Current assets like cash or inventory are assets that can be quickly converted into cash or expected to be used within a year. So, by separating these two types of assets, businesses can easily assess their liquidity and long-term financial stability. Another important aspect is relating the profit and loss account to the balance sheet. The profit and loss account shows how much profit or loss a company has made during a period, while the balance sheet gives a snapshot of the company's financial position at a specific point. Linking these two helps to understand how the results of businesses operations impact its financial health. This approach simplifies the data and provides actionable insights, allowing stakeholders to easily grasp the financial relationship within the business. It makes the information more accessible and helps in making informed decisions. One of the main objectives of accounting is to explain financial trends and patterns over time. By analyzing past data, businesses can spot trends that reveal how their financial situation is evolving. For example, a consistent increase in revenue over several months can indicate business growth, while a steady decline might suggest underlying issue. Recognizing these patterns allows businesses to make timely adjustments to their strategies. Accounting also plays a key role in evaluating profitability and overall financial health. The financial statements, such as the profit and loss account and the balance sheet, help assess how well the company is performing. These documents give a clear picture of whether the business is generating sufficient income to cover its expenses and remain profitable. Additionally, accounting helps identify the causes of financial outcomes. By examining data, businesses can pinpoint factors that led to a particular financial result, whether it's a profit or loss. Lastly, accounting allows businesses to predict future results under specific circumstances, helping them prepare for potential challenges or opportunities. This ability to forecast is crucial for informed decision making. Last is communicating. Accounting plays a crucial role in sharing financial insights with stakeholders in a clear and understandable way. The information produced by accounting, such as reports, graphs, and fund flow investors, managers, or creditors, grasp the company's financial situation quickly. These tools visibly present data, making complex financial information more accessible and easier to interpret. The detailed report and graphs allow user to view trends, compare financial performance, and identify key areas of concern. For example, fund flow statement show how cash is moving in and out of the business, providing clarity on the company's liquidity and financial health. By providing clear and organized information, accounting helps user make informed decision. Stakeholders can evaluate whether to invest, lend, or change business strategies based on the financial information provided. Accounting does more than just summarize data. It combines detailed analysis with additional financial details, giving a comprehensive view of the company's performance. This allows decision makers to better understand the financial relationship and make well-informed choice based on accurate, up-to-date data. To conclude, the accounting process starts with recording transaction and ends with communicating financial information. Each step is important and helps in maintaining accurate and meaningful financial records. If you found this video helpful, don't forget to like, comment, and subscribe to the channel. Thank you for watching.